I don't know, man. It just seems that things are starting to get really, really, really interesting in the metals market. And I would argue that the long-standing, decades-long-standing ability of the Western commercial banks to manage the price, I think it's ending. And the real flow of metal from west to east is happening. And what I find craziest about all of this is that there are very few people. You're one of them. Vince is one of them. I'm one of them. There aren't a lot of people who are talking about this, and the underestimation of the significance of this is insane to me. But it's happening in real time, and I think it's going to start to get really nuts here pretty quick with the shortages of supply and these naked short positions.
China remains firmly in control of price action in the global gold market, with recent data indicating that this dominance is likely to persist. Meanwhile, Western investors are expected to join the surge in precious metals investment soon. According to Andy Schectman, CEO of Miles Franklin, the flow of gold and silver from west to east is accelerating, with sovereign nations and sophisticated investors increasingly recognizing the strategic value of these physical assets. Though significant for the global financial system, this trend is not widely discussed or understood. In the West, central bank decisions and economic data continue to be the primary focus for buyers. Central banks, institutions, and consumers east of Germany are increasingly focused on accumulating gold, even buying into last month's price surge. The World Gold Council reported a 3% year-on-year increase in global gold demand in Q1 2024. Notably, central banks purchased more gold in Q1 2024 than in any other first quarter, driven by persistent central bank buying and high demand from Asian investors. Schectman has also acknowledged the evolving nature of the petrodollar system. Major commodity producers are no longer recycling dollar-denominated revenues back into U.S. treasuries. Instead, emerging markets and BRICS nations increasingly use local currencies and gold to settle trade balances. This shift undermines the traditional dominance of the U.S. dollar in global trade. A recent development highlighting this trend is the decision by the government of Maldives. BRICS members India and China have agreed to accept local currencies for imports, effectively sidelining the U.S. dollar. Cross-border transactions in local currencies benefit developing countries and strengthen their native economies. Under the new agreement, India and China will accept or pay 50% of all imports from Maldives in local currencies, covering half of the Maldives' $1.5 billion import bill. Join us as we delve into Andy Schectman's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
It's true. I think that there are some very interesting things going on. And when you realize that you cannot export gold out of China, you have to deposit a gold bar, your own gold bar, into the Shanghai Metals Exchange before you can then export it. So this is all about silver. It's not about gold that these bankers are showing up. It's not about benevolence. They're showing up there, and it has to do with silver. And when you look at a country like India importing between 500 and 600 million ounces in the last 2.5 years, when you realize that, the COMEX inventory has 40 million ounces or so unregistered, which is rehypothecated 1,600%. When you realize the LBMA just came out and said their silver stockpile is the second lowest it's been in the 140-year history of the exchange, they're running out of ammunition. And that's the thing. When these bankers set up this deal to create this over-leveraged system, no one ever stood for delivery more than a few percent anyway. Certainly not a sovereign nation or in coordination, sovereign nations. I don't know, man. It just seems that things are starting to get really, really, really interesting in the metals market. And I would argue that the long-standing, decades-long-standing ability of the Western commercial banks to manage the price, I think it's ending. And the real flow of metal from west to east is happening. And what I find craziest about all of this is that there are very few people. You're one of them. Vince is one of them. I'm one of them. There aren't a lot of people who are talking about this, and the underestimation of the significance of this is insane to me. But it's happening in real time, and I think it's going to start to get really nuts here pretty quick with the shortages of supply and these naked short positions. And I want to talk about our old friend Jeffrey Curry for a moment. I don't know if you saw the article that he came out with. I'm sure you probably did, as you see everything silver. But it's worth talking about because remember, Jeffrey is the guy when he was at Goldman Sachs that famously said that the ETFs are the shorts, that the ETFs short the metal into the market to hedge the position. That was a faux pas of ridiculous proportions because when you're holding someone's silver as a custodian, you're not hedging squat. They're risking the whole thing is a risk. They're hoping it goes higher. I hedge my position because I buy inventory to sell to people. I can't let it crash or I go out of business. But when you're a custodian and people are signing up to buy the metal that you hold for them, you're not hedging it. What you're doing is selling it into the market to create excess supply to manage the price. Well, he just came out and echoed a lot of the things that we've all been talking about for a long time. Did you see that article by chance?
I did, and I'm looking for it in the background here.
Well, he says the key difference between the current commodities rally and those of the past has to do with the changing nature of the petrodollar. So where have we heard that before? With major commodity producers no longer automatically recycling their dollar-denominated oil revenues back into U.S. treasuries. He says it explains a lot why gold prices, and I would add silver, are as strong as they are. And what is the evidence of that is the emerging markets, the BRIC countries, all met with Saudi Arabia and other key participants in November of last year and discuss how they're going to trade with one another using local currencies. And then whatever it nets out in settling, they would settle in gold. Where have we heard that before? And he notes that both China and India are paying for oil in local currencies and others. And he thinks that Russian sanctions on Forex reserves mean we're unlikely to see a U.S. commodity deficit recycling playing out probably ever again. Where have we heard that before?
Schectman's observation underscores a significant shift in the global financial landscape. Assets like gold, silver, oil, and base metals are increasingly being considered alternatives to U.S. Treasury bonds for settling international trade. This transition reflects a broader move away from the dollar-dominated financial system, indicating a growing diversification in the mechanisms used for global trade settlement. Meanwhile, BRICS member China has been actively reducing its U.S. Treasuries and agency debt holdings over the past 7 months, signaling a clear departure from the U.S. economy. Instead, the country has been steadily accumulating gold reserves. The People's Bank of China recently disclosed that the country holds 2,250 tons of gold in its reserves as of 2024, amounting to approximately $159 billion. This strategic shift away from U.S. assets aligns with the BRICS agenda of de-dollarization, emphasizing the desire among emerging market economies to reduce their reliance on the U.S. dollar in international transactions. Let's get back to the interview.
And I would say it's not just gold. Right, gold is replacing the treasury bond for sure, but I would add silver, I would add oil, I would add base metals, I would add, all of these commodities that are integral. But gold is the key one, and a lot of us have a bad habit of saying gold and meaning everything: gold, silver, platinum. But, anyways, he says Kerr's confirmation of gold recycling of commodity surpluses means the de facto net settlement is gold. Let's not forget that the oil markets alone are roughly 12 to 15 times the size of the global gold market. So if indeed all of these countries are selling their goods for local currencies with one another, which they are, and we've seen a lot of evidence of that, and then netting out the excess in gold, in silver, in oil, in rare earths, in copper, in whatever the hell that it is destroying little by little the value of the dollar, both its settlement and reserve status. I hope this makes sense for people. But look, you got the M2 money supply up 14 times since 1980 and still silver at 60% of its high. Doesn't make sense unless it's been managed. And there was an article or a interview that I saw on Palisades Radio, a guy named David Jensen. It was fabulous. Was really, really good. And I want to give the guy credit because he inspired me to do some digging. But what he was talking about was that the LBMA trades 292 million ounces of silver per day and 20 million ounces of gold per day, right? You contrast that to the Shanghai Metals Exchange, where you have to deposit a bar first to trade it. They only trade 300,000 ounces a day, yet LBMA is trading 20 million. And he goes on to say that there was a survey done at the bullion banks in 2011, which said the real number is 10 times that. Because if you sell 20 contracts and buy 10, the LBMA only publishes the net, which is 10. It was actually 30 that you traded. So if we take that to be gospel, that there's 10 times the amount that they're telling us is probably more, that would mean that they're trading 200 million ounces of gold per day. And that would mean that they're trading 2.9 billion ounces of silver per day on the LBMA, which in other words, they're trading over 3.5 times global mine production per day on the LBMA. This is how you suppress the price, by overwhelming the system with paper contracts. But when you realize that the LBMA silver trading is only 3% of the gold trading in terms of dollar value, it's a tiny market, and you overwhelm it with paper, you can control the market until you get countries like India, who accumulate 600 million ounces, and China voraciously accumulating it. They understand what you've been saying forever. No one was listening. I did, but most didn't, and now they will. And you will go down, as someone who saw it way early, that silver is the linchpin. And I didn't even really understand it back then. It is the linchpin of this whole system breaking apart, because it'll blow up the bullion banks, which will blow up the system. The bullion banks are the big commercial banks. It'll blow up the whole system. The lack of trust will have been shown to be of epidemic proportions. No one will ever trust us again. They won't. And I think that's exactly what is happening. This is why the banks are showing up in Shanghai begging for silver. If you can't export gold, you can only export silver. And we see massive deficits in both the COMEX and the LBMA in terms of stockpiles. Where are they going to get it to cover these short positions? And I think that's what you see happening. So I don't know, man. I think it's getting really crazy.
Considering the strategic shift away from U.S. assets, such as U.S. treasuries and agency debt, and the accumulation of gold reserves by certain countries, how might this trend influence the long-term outlook for the U.S. dollar as the world's primary reserve currency and its role in international finance? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.